All right. Welcome, everybody. Today is Wednesday. It is November 6th, one day after the election, 2024. You've got options for Income Navigator. Hope everybody's having a good day. The market is up pretty strong, right? We are seeing a reaction to the election results. Um, One of the things I want to point out is, a reaction is one thing, but what we are seeing in the volatility space is um, it's also a reaction to finally having the known unknown kind of behind us. I do want to remind everyone that we have the Fed meeting that's going to conclude tomorrow. They're going to make a decision on interest rates going forward. It is widely expected that they are going to cut by 1/4 of a point or 25 basis points. The probability of that is probably to the tune of about 95, maybe more percent now. And I believe they are going to have a press conference at 2 o'clock. I'm not exactly sure. I need to look at their schedule, but if they do, obviously the market is going to pay attention to what they're going to say because the market is pricing in another rate cut in the December meeting. So, I mean, the market's going to look for hints about their policy going forward. Now, there's another known unknown that is in play with a change in Washington. We're not sure exactly, what the future policy is going to look like. The bonds were down, dollar was pretty strong overnight. Honestly, I don't know if we want to keep rates high, if we want to get things going, but for whatever reason, the market is doing what it is doing, and it's not doing what we think it should be doing. So we need to follow the market because the market's not going to follow, our opinions. Uh, last week I talked about the S&P, and I want to go back to the chart just to kind of go back and talk about what I am seeing on the chart and how I am reading into this. So last time we talked about this chart, we were somewhere down here. The market was pulling back. Things didn't look as great as they do today. Um, Last time we talked about uh, ES and the price action, we were below 5, 8, and 21 EMAs, and we had 8 cross below 21, which was a kind of a bearish signal, if you will. And, all of that changed pretty quick. So now we need to go back and look at the chart again. What is the price telling us? We are in a uptrend. Right. And I was not making the case that, the market was going to roll over and die. But when the price is below key moving averages and we have 8 EMA below 21 EMA, to me, that's kind of a warning sign. Maybe there's a deeper pullback. Maybe there isn't. We don't know. Today, we got some more information. And with today's move up, we are back above 5, 8, 21, 34, 55. So, and as a matter of fact, we are making a new all-time high on this ES contract. So the uptrend is intact. We are currently trading still inside of the expected range for this week. Obviously, with tomorrow's Fed decision, we're going to see market reaction maybe tomorrow, maybe even on Friday. So, kind of looking at these levels, as long as we are inside the expected range, to me, it's okay. Once we get outside of the range, whether it's up or down, I am looking for a market reaction, meaning that if the market had sold premium somewhere around the expected range, which means the dealers or the market makers are on the other side of that trade, that will force them to hedge their positions. And there are times when we get outside of these ranges, the market just starts to actually escalate and things are starting to pick up. Meaning, if we get outside of the expected move range to the upside, we might see further push to the upside as the market participants are forced to hedge their positions into the end of the week. And the same thing on the downside. If we get below the expected range to the downside, things start to pick up. Sometimes it doesn't have to work that way. Sometimes we see a dip outside of the expected range, catch everybody on the wrong side of the trade, get back inside and squeeze everybody. So it's not the exact science. You just have to kind of go with the flow, keep an eye on what's happening around some of these levels, and try to read into what the market is telling you. For right now, I think I would be leaning on putting on new positions with positive delta. I think it's okay. Volatility is coming out, which should help. Also, with 821 and 34 aligned in a bullish formation, I think it's okay to initiate new trades with positive delta until that changes. Um, so those are my thoughts about what the ES or S&P 500 is currently doing. Um, Again, with the Fed tomorrow, it's kind of hard to use one day as a sign or as a indicator for what's to come in the next couple of days. But for right now, with the market making a new all-time high, I'm going to look for market reaction to the news tomorrow and Friday. And then maybe we'll look at this again on Friday just to kind of, as we get a little bit more information, maybe we can continue to kind of talk about what the price is telling us and what we may be doing or what kind of positions we may be looking for going forward. I did shave off some risk going into the election. In hindsight, right? You can say, man, I should have been adding more risk, but I think that's the wrong mindset. You don't want to trade in hindsight. Hopefully, you did what was best for you going into the election because we could have been down, a limit down after the election and it wouldn't feel so good. So for right now, we got that out of the way. We got some more information. And now we need to just figure out, what are we going to do going forward? I don't like to, chase the market and, oh, we're up, 2% on the S&P. I'm way behind. I have all this buying power. I'm not making any money. Wrong mindset, completely wrong. You should have, somewhat of a schedule when you're going to put on new positions, what kind of positions you're going to put on. And don't, there's nothing here today that will tell you or should tell you that you have to use up all of your buying power because otherwise you're just chasing a runaway train, right? The market is going to be here tomorrow, market's going to be here the next day and the next week and so on. So you will have an opportunity to deploy all of your capital. Just be smart about it. The volatility, it's down all across the board. We have the VIX is at 16.32, which is kind of the norm, right? We've seen VIX lower. So maybe we can, look at a chart real quick. And again, I don't really like to look at the chart and try to derive something from the VIX itself because VIX is just a reflection of the demand and supply for protection 30 days out. I don't think it's the exact or the best indicator to use as far as market fear, only because there's so many more expirations available, and sometimes market participants reach for other expirations that are much shorter than 30 days when they are looking to protect against some kind of market moves in the near term. But as you can see, after the August event, the volatility has been in a range. We've seen, something as low as maybe 14 and a half, maybe 15. That would be the lower end of that range. And on the high end, we're somewhere in the, between 23 and maybe 25. So right now we are towards the end or lower end of this range on the VIX. Really doesn't tell us a whole lot. But the fact that we are seeing a pretty good dump in tail risk, right? The market is not as afraid of some sort of an outlier move right now, which is good. Again, I keep saying that I prefer to trade in low volatility environments. And if the VIX is going to stay or volatility, whether it's tail or 30-day or 90-day, as long as the volatility stays relatively low and realized or historical volatility stays relatively low, strategies that I use are going to do really, really well. I know that the the general idea that we should be selling a ton of premium when volatility is high, it's the right idea, assuming that volatility is going to go from high to low. But sometimes when volatility is high, which means the market is really concerned, the market is nervous, and when the VIX gets into that 25, 27 area, you should expect at least a 1% move up or down any given day. And sometimes those are not the best environments if you are a net option seller. So if you can perfectly time that window when the volatility, implied volatility, is going to start to roll from high implied volatility to low, you're going to do really, really well. Um, I prefer to trade when volatility is already low and it stays low. And if you go back and you look at the chart of implied volatility, there are a lot of times when volatility gets low and it just stays low. Right. So you can go on stretches of, 3 months, 6 months where volatility is low. You may not be thinking about selling premium because volatility is low, so you shouldn't be selling premium. But those are the times, at least for me, where you make the bulk of your steady income. I'm going to switch over to, and we can talk about the Russell, but Russell is kind of doing its own thing. In my opinion, we saw a big spike in the U.S. dollar, and with Russell being an index made of 2,000 small cap companies. These are US based domestic companies. And if we are going to have a stronger dollar, I think all domestic companies are going to benefit from that. They don't have a lot of exposure to foreign currency. And maybe that is the reason why Russell is up. I mean, it was up as much as 6%, but I was looking at the Russell futures. Right now, Russell or Russell 2000 is up 5.38%. I believe this is an all-time high. It has been trading in a range. We're breaking out of that range. Volatility or Bollinger Bands are, opening up. I think if anything else, I would look for Russell to continue to drift higher. There's also some sort of correlation between interest rates and small cap stocks, but I think this is mostly due to strong US dollar. Let's have a look at. I was looking at a couple of positions that I have in SPX. Those are income butterflies, and I had a couple of questions, so I definitely didn't just want to throw out answers. I would rather give you my thought process and kind of walk you to my answer so that you're following some sort of thought process and understand exactly how I get to that answer. If you give me 1 second, I am going to switch over to Option Explorer. Hang on. Hopefully we don't break anything. All right, you should be seeing Option Explorer screen. This is a leftover position that we've had on for 85 days. As you can see, in this 85 days, the underlying, which is SPX, has moved just outside of one standard deviation, and now we have 9 days to go. We're kind of sitting in this area where, I mean, if we pin the what's that strike? We are at 59.20. It's exactly almost where we are right now. 9 days from now, this is like the worst thing that can possibly happen to this trade. I mean, the odds of, pinning 59.20 is really, really low. So my idea is just to, leave this position alone. I don't think we're going to pin 59.20. I think we're going to be somewhere above or below it. Either case works for me. If we are above 59.20, I'll have some of or all of the legs of this trade in the money. SPX is a cash settled instrument, so I don't have to worry about assignment and anything like that. So if they are in the money, we'll just get cashed out for the difference between the strikes. And again, our upside is limited to just over $1,600 in this position. I can also take a look and see how much margin this position is currently taking up. This is a trade number 2933. And I'm going to take a look. And right now, this position is taking up just under $2,500 in buying power in a portfolio margin account. So it's very insignificant. I don't really want to close this trade because, we have 20 contracts with the fees. It just things like that start to really, it's not a lot, but it's going to start to eat into your profit. So I think it's just easier to leave it alone. But you do have to keep in mind that, if we just, for whatever reason, you know, hang around 59.20, right? And we only have 9 days here. So in 9 days, right, you can see that, the T plus zero is going to kind of gravitate a little bit towards, or it's going to pull down a little bit. And that's because we're short the 59.10, we're short the 59.30, but we're long, right? 10 contracts at 59.20. So if we're at 59.20, these contracts will go out worthless. So we'll take a major hit. Again, I think we're going to be somewhere above or below, specifically looking at these wings. But if we do pause and kind of just sit around here for the next, by this time next week, we're going to have a much better idea. And if we're still somewhere around 59.20, then I'll just, pay whatever the fees are to close this thing out and move on. I don't want to hold on and look at it too many more times. So that's one position we have on. I also have a position. This was a leftover position. Now, this was a delta hedge in case, and it still is. I mean, I still have 86 days, but now this position is pretty far out of the money. It's 99.9% chance it's going to go out worthless, which is okay with me because I was able to recover all of the debit that was paid for this put debit spread. So it really makes no difference. If for whatever reason, inside of the next 86 days, the market decides to pull back 30%, something like a COVID crash, obviously holding this is going to be a great idea. If we don't crash and I'm still holding this, it's not a terrible problem because I can't lose anything in this trade. Everything that I paid for it has been already recovered. So now I have two butterflies that I have running. This one here, trade number 3003. And we have been in this trade for 33 days. In this time frame, the underlying has moved 0.8 standard deviations to the upside. So we're not really moving too far outside of what was already being priced in at the time when we took the trade. We still have 44 days to go. We know that our upside potential or profit potential is limited, right, to the net credit that we're able to collect in this trade. I believe we made two adjustments here. Again, if you want to see what kind of adjustments, I don't really want to go and spend too much time talking about these specific adjustments. But the idea is, when we put on this trade, we're going to give it some time to work, and then we're going to look to potentially raise our tail profit line, right? Anything that's to the right of the structure, we're going to look to raise our potential profit on the upside by rolling the long legs in towards the body of this butterfly. So we made two adjustments so far in the last 33 days. We know that the most, and this is a 10 lot, so the most this trade could make is a $2,600 profit, $2,650. We're currently showing a P&L of plus 1,700, which is not terrible, but I think that the first question I saw about this trade was from Ivan that said, should we just close this one? And, the reason why I wanted to save this and to talk about this here instead of just, spitting out an answer is I want to kind of point out what I look at. So we have 44 days here. And the first thing I'm going to do is I'm going to look at how much buying power does this trade currently take up. So this is a trade 3003, and I'm going to look at my broker platform to see how much buying power this trade is taking up. And right now on a 10 lot, I am seeing a buying power take up of about 27,000, right? So $27,000 is being tied up in this trade. How much more can I possibly make if I do nothing else? And assuming that we're going to stay somewhere above, let's call it 55.25. The remaining potential profit in this trade is around 900, maybe $1,000, right? So right now we're seeing about, it's moving around. So, you'll see this number jump a little bit, but somewhere around $950, maybe it's $1,000, right? That's the most we can possibly make. So we kind of have to think to ourselves, we have a potential to make an additional $1,000, and we have $27,000 that is being tied up. And that's over the next 44 days. I don't think there is a right or wrong way to go about this, but you want to think, can I possibly make more than $1,000 on $27,000 of risk over the next 44 days? Now, if the answer is yes, then it probably makes sense to close out this trade and move on to where you're going to make more than $1,000 on $27,000 worth of buying power over the next 44 days. If the answer is no, right, and this is a pretty high probability trade here, assuming our downside break even is somewhere around 54.25, we can go back and look at 54.25 strike, right, which is a delta 8. Oops, sorry, it's actually delta 2. So it's safe to say that we have about a 95% probability that the price, or S&P 500, is going to be somewhere above 54 and a quarter over the next 44 days. So you can just leave this trade alone. I don't think we're going to get a lot more or any buying power reduction even as this trade matures, because portfolio margin buying power requirement will look up and down 15%. And as you can see, if we move our price slice down to about minus 15%, it's currently at around 25,000. And then as this trade continues to evolve, you'll see that my T plus zero is actually going down towards what my risk at expiration looks like. And I think at expiration, if we were here where we are right now, and we're looking at maybe 40 days into the future with 4 days to go, a minus 15% slice, our buying power could actually expand a little bit more, right? So we have a very safe trade based on today's price action. We have potential of an additional $900 on that $25,000 or $27,000 worth of buying power. I think the easiest thing to do is do nothing, right? Let's see how the market is going to digest everything that's happening right now and what the reaction, if there is a reaction to a rate cut over the next couple of days. Maybe we'll circle back to this trade this time next week and say, hey, what's changed? Again, if whatever is happening and we're just sitting here and maybe this trade is not really gaining any ground, right? We're not really making anything as the market is moving, because if the market starts to move higher, I don't think that this $900 is going to fall into our lap anytime soon. Reason being is because as long as there is time until expiration, the strikes or the contracts that we're holding here, they're going to have some value. They're not going to all go down to zero. In order for us to capture this $900, all options, which means the long options at 55 and a quarter, the short options at 54.75, and the long options, down at 53, whatever it is, they all have to be worth nothing. As long as there's time until expiration, this trade is going to kind of just sit there and do very little, right? So we'll look at it again next week and say, you know what, can we maybe use this capital somewhere else? Maybe we can close this out and, initiate a new trade. Maybe that's a possibility. If you want to just kind of have a really hands-off approach, say, you know what? I don't care how long. I mean, we know that it's not going to take any more than 44 days. If you're really comfortable with holding a position that's going to take up, between 25 and $27,000, and all you're going to make is an additional $900 over the next 44 days, then your choice is to do nothing, let it work. You will have almost nothing to do in this trade unless the market starts to move down, to the tune of about, maybe it's 3.5%. So you may set a price alert for S&P at 5,700. Anything above 5,700, you don't even have to look at this trade. You already know what it takes. You already know how much you're going to make over the next, 44 days. And as long as we're above 5,700, you can go on about enjoying doing things, whatever you like to do. You don't even have to look at this trade. Right. So that's the idea. Be very passive. You don't have to, jump out of bed and look at this trade. As long as we are above 5,700 on the S&P, you don't have to look at it. You don't have to really worry about it. If and when we get down there, you can again look at the chart, understand, what we're doing as far as price action goes, and make a decision if you need to do something to this trade to defend it. Because even at 5,700, you're still pretty far away from trouble, but that's where you kind of maybe want to look at, maybe remove some of your directional exposure. And I'm talking about delta here, so that you can continue to hold and be comfortable with it. But for right now, I think I'll just leave it alone and just let it be. One idea I had when I first looked at it was maybe roll in the wings one more time. And we're going to look at that just to kind of, we want to explore every single possible possibility and figure out, does it make sense to do it? Maybe it is, maybe it isn't. So let's have a look, right off the bat. The first thing I look at here is if I'm going to start rolling my long wings, how much more credit am I going to bring in, and is it worth it? Right? So I'm going to roll a 12 delta put. Now I know that if I'm going to sell this 55.25 puts and I'm going to buy something lower, essentially doing a put credit spread, that's going to increase my risk on the downside. Okay, I can drag my downside long put up to kind of keep that risk in check. But again, because we're not really utilizing a lot of leverage here, right? The absolute risk and the risk that your broker is going to, or the buying power that your broker is going to ask for, they're going to be very similar. So we're not really gaining anything by rolling the downside leg up. So let's look at, maybe we'll sell 10 of the 55.25s and maybe we'll roll it down, I don't know, 25 points. So we'll roll from 55.25 down to 5,500. Right, this is a put credit spread. Right, we're selling a higher price strike and we're buying a lower price strike. We're bringing in $1.70 credit on 10 contracts. So we'll bring in an additional $1,700, but our risk goes, from 27 or whatever it is. This will increase quite a bit, probably somewhere around in the 40s, maybe low 40s. So, to control the risk on the downside and control the buying power, will drag the downside long put from 53.95. Maybe we'll roll it up 25 points, right, to 54.20. Okay, so as you can see, we are getting a little bit more potential to the upside, and that little bit more is equal to the credit that we're collecting, which is 60 cents, maybe 50 cents. on 10 contracts. So we're not um, collecting that $1,700. Now we're cutting that $1,700 down to only $500 because we're also paying a debit to keep our downside risk or buying power in check, right? So we are essentially selling a put credit spread and we're buying a put debit spread. We're pinching in the wings, as you can see, that the size of our tent, right, gets reduced quite a bit. And we don't really care about that, right? We don't plan on making the profit inside the tent, right? We're just looking at how much more can we squeeze out of this trade and how much more risk will it take. Just looking at the risk graph, if we were to pinch the wings in and bring in an additional, maybe 50 or 60 cents, our risk will probably increase by maybe just a couple of $1,000, which is not a terrible idea. It doesn't really change our Greeks all that much either, right? As you can see, we go from having a 5 delta or 5 S&P delta to about 8. I mean, in relative terms, it could be a lot, but in absolute terms, whether you're holding 5 shares of SPX or you're holding 8 shares of SPX, it's not that big a difference. We're also going to increase theta a little bit more. So those are, in the bullish market, those are positive. But the one negative is that we're also increasing a little bit more sensitivity to Vega or changes in implied volatility, meaning that if volatility increases, meaning if we're going down on the S&P and volatility increases, we may take a little bit more pressure due to the rise in implied volatility because now we go from being short 100 Vega to being short about 230 Vega. All right, so it's all give and take. This is the process that I use. This is how I look at these trades. I look at, this is the only adjustment. We can go, and explore other adjustments such as, doing some kind of calendars or adding more butterflies here. But I just think that it's too much, too many moving parts. I'd like to keep it simple, right? So if I was to put these different adjustments in a row from simplest to the most complicated, the simplest thing to do here is to just leave this trade alone, right? And really not have to worry about until we get below 5,700, maybe 5,650. That is the easiest thing to do. The next thing, if you want to be a little bit more greedy, then you roll the wings in, collect a little bit additional credit, get a little bit more exposure to price, delta, and to volatility, Vega, in exchange for a little bit more theta. That's also pretty simple adjustment to make. And then if you really want to get your hands dirty and be a little bit more active, then you can start to do some kind of calendars around maybe 5750 and look at this trade on a day-to-day basis, make further incremental adjustments. But honestly, to me, I think it's just a little bit too much work without a significant return on that time that it'll take to manage this trade. What I'm going to do with this trade, I'm just going to leave it alone. I'm going to circle back to this trade this time next week and I'll make a decision then. Maybe we'll hold it longer. Maybe we don't. I don't know. Let's have a look to see if somebody have any questions about do you put on a mini call, broken wing butterflies for a bearish view? I'm a little leery of adding many bullish positions with the market at this level. So one, and I might have mentioned this before, but as a rule of thumb, right? And everybody should really learn this probably like the first thing. If you ever consider doing these kind of directional butterflies, because this is a directional trade, right? As long as the delta is not zero, it could be positive, it could be negative. If the delta is not zero, right? So if I'm doing a bullish trade, I'm going to use the puts. If I'm doing a bearish trade, I'm going to do the calls. Right? If I'm more so neutral, then I'm going to do maybe an iron butterfly or something like that. Right? Most of the time, I'm going to use broken wing put butterflies. I rarely use call butterflies, and that is directly related to the equity skew that we're seeing, right? Where volatility on the downside puts usually have a little bit more implied volatility than the calls do. So if I'm going to be net seller of out of the money premium, I want to use puts to the downside because you get a lot more premium because of that skew. If we were to set up a bearish trade using call butterfly, which is not wrong, right? If for whatever reason your chart is telling you that we're stretched and the market is maybe three standard deviations away from a 21 EMA or whatever that indicator that's telling you that the market is unlikely to continue to trade higher. Yes, you can, set up some kind of a out of the money call butterfly. The problem is that in order to really justify the risk, you won't be able to place your call butterfly far enough out of the money because there's just not enough juice or premium in the out of the money calls most of the time. Right? So most of the time I'm going to use out of the money put butterflies and I will control the widths of these two spreads, right? We have a put credit spread and a put debit spread. I will control the widths to number one, define my risk to the downside and also to control how much credit I'm collecting up front. And you can see in the next trade here, we put this trade on. This was 22 days ago. I have not made any changes to it, right? My goal was to put it on, give it maybe 30 days, right? I put it on with 77 days. I said I'm going to give it a month, right? As long as we don't go inside the structure or below the downside break even, I just want to kind of let it do whatever it's going to do. Now, granted that this trade looks a lot better today than it did yesterday or maybe the day before as the market was pulling back, right? Today we have a market that's pushing higher, volatility is way down. So yes, this trade today looks a lot better than it did yesterday. And let's, have a look at what it looked like on Monday at the close. Right, so this is Tuesday at the close. So on Tuesday, we were much closer. Hang on one second. Let this thing continues to change as I keep clicking these dates. But we go back to Monday, right? So this is Monday, November 4th, and you can see that as the market was pulling back, and we were sitting right on the 50-day, right? I hope you can see that, right? So as the market was pulling back, this trade was at a small loss, which is fine, right? There's a lot of time. We still have quite a bit of room to the downside. There's nothing to panic about. But then we had, let's go forward one day. This is Tuesday, the 5th, right? And yesterday, the market was pretty strong going into the election. So things were changing already, right? Volatility was coming out and the price was moving in the right direction. And then we'll look at today. Right? More volatility is coming out. The price is moving farther away from this structure. Um, and you can see that one sometimes just shows like this really weird risk graph. There we go. So now it should be fixed, right? So we are moving away from the structure. Volatility is coming down, which means that all options that are part of this trade, right? We have long options, we have short options, we have more long options. They're all losing their value today for two reasons. One, because the price is moving away from them, right? So these options are becoming farther out of the money, right? Which means that probability of these options going in the money is lower today than it was yesterday. And implied volatility is falling. As you can see, we are short Vega in this trade. So we get the benefit of short Vega as well. Jeff is asking, are we now close to max profit? We are, right? If we were to close out this trade right where it is today, right? This trade, and I hope you can see this trade is currently going for about a 10-cent debit. So we collected $1.80 to get into this trade. Now we have to pay 10 cents to close this trade. We get to keep $1.70, right? So 170 is our profit. I'm not accounting for any fees and commissions that you may be paying. I'm just talking about, credits and debits. We collect 180 to get in. We pay 10 cents to get out. So we get to keep $1.70. So we know that if we continue to hold this trade and we do nothing else to it, our upside or our profit potential here is about $100, which means, remember, we just talked about this. If we hold this trade for 55 more days, the most we can possibly make is about $100. Now let's see how much margin this trade takes up. So this trade is 3032. And I'm going to take a look at what this trade takes. As far as buying power goes, in the portfolio margin account, this trade takes up about $39,000. Right? So on $39,000 that's being tied up, we're going to make $100 over the next 55 days. To me, it's not a great rate of return. So now we need to make a decision. What are we going to do here? Can we just close this out and move on? Yes. That is probably the simplest thing to do. But because, the structure is not terribly far out of the money, given that we have 55 days, maybe we can roll the wings in. Same thing that we did with the previous trade we just talked about. Right? Our long leg of the put debit spread is a little bit closer. Remember, the other one was like delta 12. This one's delta 17. So maybe we'll sell the 5,600, roll it down 25 points. I'm starting with the 25 points. You can start with, what does it look like if we roll it down 5 points or 10 points? Whatever you want. This is your trade, you can do whatever you want to it. I think I'm leaning towards, rolling it down 25 points is because I don't want to make too many adjustments, and I don't think that 5-point roll down will give us enough credit to make it worth it. Right? If I roll it down 10 points, what am I getting? $1.10. Okay. I mean, not terrible, but it's going to put me over my planned risk on the downside, which means I now need to drag my downside long puts, right? I don't want my Reg T margin exceeding $50,000. And if I just roll down my upper longs, this will take my Reg T margin to $57,000. I will be $7,100 over my planned capital. Right? So now I have to roll my downside long, which means that I'm going to be paying a debit. I'm collecting $1.10 for rolling my upper longs down, but now to fix my margin problem, I have to pay a debit to roll my downside longs. So if I roll those 25 points, right, I fixed my downside problem. But what am I collecting here? 20 cents, right? 10 contracts, that's $200. You factor in the fees to roll 40 contracts on SPX, it's just not worth it, right? So these very small rolls, and I made a mistake here. I rolled the downside 25 points. We should have done 10 first to start. So let's see what it looks like if we just do it 10 on the upside, 10 on the downside. So we'll get a net credit of 50 cents or $500. It's not terrible, but you know, it doesn't really improve our position all that much, which means we'll still have about 40,000 or something close to it, $40,000 of buying power tied up in this trade. And all we have as far as potential reward is an additional, you know, $600. I don't know if that makes a lot of sense. So let's have a look. Maybe we can roll it instead of up and down 10 points. Maybe we'll do it 25 points, right? So we'll do a bigger roll. That's 10, 20, 25, right? So that's my downside roll, 25 points up. And on the upside, I roll my longs from 5,600 to 5,575. And I'll do 10 of those. Okay. So this looks a little bit better, right? In my opinion. Risk, even though our Reg T risk is about the same, portfolio margin risk is going to increase just slightly. And we are going to be able to bring in $1.30 on 10 contracts. So that's an additional $1,300. So now we have the $100 that's currently left over plus $1,300 that we're going to bring in. This means that over the next 55 days, by doing this adjustment, we have a potential for an additional $1,400 or $1,300, right? So our max potential reward to the upside is $1,400. Margin is going to remain about the same. Our Greeks are going to change, right? We go from literally being delta neutral to being long about 6 or 7 shares of SPX. So for every 1 point, we should expect our P&L to move plus or minus $7. Our theta stays about the same. We're definitely getting a little bit more negative vega here. So now you have to ask yourself, do you want to change your directional exposure from neutral to positive? If I'm not going to say, it's right or wrong, it's your decision, right? Because you always have to do what's right for you. So if you are okay with changing your directional exposure from neutral to positive or to positive delta, then this is one adjustment I would consider. Remember how I said that you can go one of several ways. You can do nothing, which is the simplest and the easiest thing to do. I think in this case, doing nothing is wrong because we don't have enough reward, right? We only have an additional 100, maybe $150 to be made over the next 55 days. I just don't think it makes sense. If it makes sense to you, then by all means, stay in this trade. And it's also a fairly high probability trade over the next 55 days. Right. But if I'm going to stay in this trade for, an additional 30 days, at least I need to have some sort of incentive. And that incentive is by collecting an additional credit by rolling down my long options. Right. I'm going to roll my longs down on the upside, and I'm going to roll my longs up on the downside. Right. So we squeeze in the wings. We're able to squeeze out a little bit more credit, and our risk stays almost the same. Can we do some kind of fancy schmancy butterflies, calendars? Yes. I think it's a little too much. I don't want to introduce, different expiration cycles and now worry about implied volatility across different expiration cycles. Just want to do what's, the simplest and the easiest thing possible. I want to have a trade that requires, as little management as possible. I don't want to have a trade that, requires me to look at it multiple times a day. This trade here, if you chose to stay in it, it requires nothing. It just requires you to be patient for the next 55 days. If you roll the longs in towards the body of this trade, yes, you'll have a little bit more directional risk. And as long as you look at the S&P, if as long as we're not down 3%, as long as we're not down 2%, odds are you don't need to, drop everything that you're doing and go log into your platform to make some sort of changes. It's a very hands-off kind of a trade, right? So the goal is find me a reason to stay. The only one that I can consider here is by rolling the wings in, collect an additional, $1,300, and then maybe let another 2 weeks, maybe 3 weeks go by, assuming that we're not trading anywhere near the tent, and then again go through the same process, right? Look at where we are as far as P&L goes, how much meat is left on the bone, meaning how much more potential reward we have, how much buying power does this trade take up, and then make a decision from there. Maybe there's another adjustment, maybe roll the wings in again, see how much that's going to yield. And, but it's a repeatable process. You could do the same thing every single time. Really don't have to so your decisions aren't driven by some sort of green light, red light, fancy indicators, or all of that is nonsense. Yes, you can look at the price and kind of understand what the market is doing, right? But your decisions as far as managing this trade is not based on price action or indicators of, where we are, 50-day Fibonacci, none of that stuff. Look at where we are, how much more profit you have, how much does this take? Can you reuse this capital somewhere else? And overall, maybe you're looking at, the market was rolling over here where we were. If instead of going up the way we did today, if the market continued to roll lower, maybe we needed to bring in some sort of a hedge to remove some of that directional risk. So to the downside, yes, maybe I would look at the chart to understand, are we really rolling over and I'm holding a bullish position and I need to kind of be a little bit more proactive with it and try to bring in the hedges to buy me the time that I need, because we still have almost 2 months in this trade until expiration. But once we, moving away from the structure, or technically this is where the risk is, right? We're moving away from the downside. Our risk is on the downside. As long as we're moving away from our risk, we just need to figure out a way, to make it worthwhile staying in this trade. Try to keep things as simple with these trades as possible. And I think that, these are going to work really, really well in a low volatility environment. You don't need, I mean, yes, it's great when you're able to capture a lot of premium when the market is, the market has been selling off, volatility has been rising. You put on the trade, and now the market is going in your favor, and volatility is falling, which is going in your favor as well. Those are going to be the best and the easiest money that you're going to make with this trade, right? But as long as we're not flying all over the place, as long as implied volatility is not at 30 and we're moving, 2% up, 2% down on a day-to-day basis, this is a very boring trade. This is a very, steady, it's pretty stable. And a lot of times you're just going to look at it and say, my God, I have been in this trade for like, a month and a half. I haven't done anything to it. Good. As long as you keep on checking on, where you are as far as how much more profit is left to be made, how much time is left, and how much buying power it takes up. If all those things make sense to you to continue to stay, then stay. If you need a little bit more reason to stay, then consider making some sort of incremental adjustments with the wings, right? I think rolling the wings is like the easiest thing to do. Sure, you can say, you know what, maybe I am going to, instead of rolling this long put down, why don't I just sell an additional put credit spread at a 15 delta. Okay, let's see what that looks like. Maybe we'll sell 5 and then do a 30-point wide. Okay. We just messed up our tent, which is okay, right? We don't care about the tent or the shape of it. We're bringing in a credit. How much credit we're bringing in by putting in another put credit spread? It's $2.60 on 5 contracts. So it's about $1,300, right? Very similar to what we just looked at. Is our downside okay? It isn't, right? It's exceeding that, well, at least for me, that $50,000 mark. So I don't want to have more than $50,000 of Reg T margin in this trade. Okay, let's go and fix our downside. How do we fix our downside? Maybe we need to buy a put debit spread. So maybe we'll buy 10 here and then let's see what that looks like. Oops. All right, so that really doesn't change a whole lot. So you'll bring in an additional, 50-cent credit. It takes your potential reward. Doesn't really change our risk graph all that much, right? We stay delta neutral before adjustment to about plus 1.2 delta. Doesn't really change a whole lot. Takes our Vega a little bit higher and gives us just a fraction of more positive theta, and gives you an additional $250. All right, that's your incentive to stay in this trade. So to gain an additional $250 in the tail, we just shaved some of the potential reward inside of the tent. And as you can see, our downside risk didn't really change a whole lot either. So we're now looking to increase our potential reward in the tail at the expense of, tearing down some of the potential reward inside the tent. And as I continue to repeat myself, the tent profit doesn't matter. We're not here to make the money inside the tent. Right. So many different ways to kind of go about this. So maybe you'll make this adjustment, you collect an additional $250 and you leave this thing alone for another week. 1 week later, you come back and say, all right, where are we? What else can I do? Or, don't look for something to do, but if you're running out of reasons to stay, then you'll look for ways to maybe, tear down some more of this tent and bring in additional credit while keeping your downside or Reg T risk in check. And then as time continues to run off the clock, once you get into that, 25, 21 days until expiration, depending on where you are and how much more you have to make in this trade, you could probably look to get out of that trade altogether. Right, so we're going to continue to talk about these butterflies. I think this is a very, very flexible trade. I think this is also a great, great trade for those traders that don't want to do naked, futures. And I'm not saying that this is superior or, this is the right thing and everything else is wrong. There's just so much more to trading than just, selling a bunch of puts naked. And you can define your risk here any way you want. You can put a butterfly, right? So like if I do 150-point wing on the downside with a 100-point wing on the upside, right? The difference between these two wings is 50 points. That's $5,000. If you are someone with a smaller account and you say, I can't put $5,000 per one contract. Okay, so then make the difference between these two wings instead of 50 points, make it 10 points. Right? 10-point difference between these two spreads is only $1,000 plus minus whatever credit you may collect. So you'll have a much smaller tent to start, but you also will have to put up a lot less capital. And you can learn to do these trades on a much smaller scale. And then when you're, confident, when you're pretty stable as far as or consistent with your input and your output, you can say, okay, I've been doing, whatever, maybe a 10-point difference in these two spreads. That's $1,000 per spread. Maybe I'll increase the widths Or maybe I'll increase the number of contracts and push a little bit more risk into this trade. And as you become more and more comfortable with this trade, you can really scale these up to, you can trade these. I mean, SPX options, you can easily get in and out of, 300 contracts almost in a single order. Right. You may want to break them down because if you are trading that kind of size, it gives you um, the flexibility of, scaling in and out, maybe trading around a core position and whatnot. But, these are a little bit more advanced, and we can talk about this and we will get there. Right. But for right now, the idea for everybody to understand is, you know, what the structure looks like and what is the protocol, or what is our goal? What are we doing and why we're doing what we're doing with this trade? And what other adjustments we can consider, right? And we want to look at the rewards and the risks, right? Because if we're gaining something, we're definitely giving something up. How to measure that, how to quantify that, and how to make decisions. And again, I don't want to be the one to tell you you should do this or you should do that. Because if you rely on me, and I'm not saying this because I don't want to help, that I'm here to help, but I don't want to be the decision maker for your trades. Because if you constantly rely on me or Tom or anybody else to make a decision for you, you're only going to, or your results are going to be as great as the person that's making that decision. And the first and the next time that something goes wrong, instead of taking the blame, you're going to look for that someone that you relied on to make those decisions to be the scapegoat. And that's the wrong approach here. You're here to learn, you're here to understand how things work. And we're here not just to give you the right answer, but to teach you the process to get to that right answer. All right, so I'm going to roll the wings in this trade here. I am going to take the 5,600 down 25 points. Right, so I'm rolling the 5,600 down to 5,575. I am going to roll up my lower long from 5,350 up to 5,375. I am collecting. So the mid is 125, right? Now it's 130. It's not hard to find the market in SPX, and because I hear this a lot. Oh, bid ask is so wide, this, that, and the other. But the reality is we go to the market. The market doesn't come to us. So we know what the mid price is, or what, at least what it's showing. If I'm looking to collect $1.25 or $1.30, and I'm not really sure where the market is, I'm going to start with like $1.60. And if I'm doing a 10 lot, maybe I'll start with a 2 lot, right? I'm going to put out an order for 2 contracts, 2 out of 10 at $1.60. And I'm going to work my way down from 160 down to 155, down to 150. At some point, I'm going to find where the market is, and that's where I want to do my business. If you see a mid price at 130, you put in an order for 130 and you don't get a fill right away, you go screaming, oh, the market is rigged. It's the wrong way to think about the market. And again, they're not coming to you. You're coming to them. Remember, you're trying to execute 4 legs, whatever the size is, for whatever price is. The other side of this trade, right? They have to figure out how, and it's the market makers, right? You're not going directly to another retail customer. The market maker has to figure out how to offset his risk. And if you're giving him a trade where he doesn't have the edge, or he doesn't have the immediate way to remove the risk, then yeah, you might get stuck sitting here at $1.30 and not getting a fill, and you may have to give up a nickel or two to give them the incentive to do the trade, right? But I will start with $1.50, $1.60, depending on where the mid is. If the mid is all over the place, going from like 90 cents to, $2, it's a very wide jump in the mid price. But based on what I'm seeing right now, right, we go from $1.20 to about as high as $1.35. So maybe I'll start with a smaller size at $1.60 or $1.50 and let it sit there for a minute or two. And then I'll take it down a nickel and I'll take another nickel down. At some point, I will find the market. And when I do, now I understand where they're willing to do the business. And I'm going to try to get the rest of my contracts at around that same price where they gave me a fill first. Hope that makes sense. So I am going to, right, what I do is I go to send without commit, and then I copy. So this will copy this trade order, and then I go to the platform and I paste this trade order, right? This is a condor. Let's see, I'm going to do two contracts, and the mid is 135. Let's go to $1.50. And at $1.50 on two contracts, that's a $150 credit per contract. Obviously, there is no fill. It's not because the market is rigged. It's because, I started way higher than the mid was. I'm going to create duplicate order for a dollar. Yeah, let's go to $1.40. Right, nothing there for $1.40. I didn't expect it to be there for $1.40. Right, the mid is somewhere around 130. So maybe I'll do another duplicate, another order. So that will be, if I'm doing two lots, this is my third two lots. I'll have a six contracts. Let's see. Let's go to, so I have one order at 150, one order at 140. Let's do one at 130. Okay, no fill at 130. Mid prices at 120 to 125. Now it's at 140, but no fills, right? So I have one order sitting at 150, one order sitting at 140, one order sitting at 130. Let's do one more. Create duplicate order for 1.25, 125. $125 filled. So I filled two contracts at 125, and then I'm gonna do cancel and replace the 130 to 125. I got two more at 125. So now I have four contracts. I need to do 10. And I'm gonna just do, so I have four. I'm gonna cancel replace, make this six. I'm gonna make the rest six contracts for $1.25. And then I'm gonna cancel the one last order that I had the original for 150. I'm gonna cancel that order. So I rolled 10. All right, so I rolled the wings in for $1.25 credit, and that is that. I'm going to post this trade, and then we'll come back and look at this trade again. If nothing drastic happens between now and next week, we'll come back next week, look at it again, talk about it a little bit more, and that's going to do it. That's the process that I follow. Hopefully, you get to learn a little bit more about the process that I use to look and think about these trades. And if you have questions, you can ask on those specific trade threads on Discord or in the main chat, wherever you can catch me. All right, so we're going to cut off here. I'm going to let you guys go. Thank you for joining me. Thank you for taking the time. Hopefully, you learned something new. I will be back on Friday. We'll look at some ES positions. Between now and then, I also have to do another trade in ES. I'm going to do a 1-1X income trade. And I think I'm going to add one more 1-1W bear trap. So we'll try to get that done. Maybe we'll push this out to Friday. So we'll do it live together. All right. I'm going to let you guys run. Have a good rest of your day. I'll talk to you guys next time.